Hey, what's going on, my friends? It's your man Adam Ace Spencer here with another look at our dividend portfolio. Yes, every week we contribute $25 into this dividend portfolio. And as you can see right now, over the past day, we are down 0.64%. And yeah, it's unfortunate. The past week, we're down 1.51%. However, the past month, we are up 0.76%. The past quarter, we're up 3.35%. And the past year, we're up 12.13%, which we started this portfolio back on February 3rd. And things are going pretty well as we today are currently sitting at a current value of $1,990.83, technically down from last week, as we just saw here. But we're not worried about that. We are not worried about that because this is our dividend portfolio that we will be investing in this for the long haul, right? So when we dive into our portfolio to see who is performing well, who's not really doing so hot right now, you can see PepsiCo is at the top of our list, up 39.15%, followed by Newt, up 30.62%. Then we have Coca-Cola up at 30.06%, followed by Procter and Gamble up 26.79%, Realty Income Corp up 22.90%, Johnson & Johnson up 7.99%, JP Morgan and Chase up 7.52%, and then Verizon Communications up 0.58%. Unfortunately, in red, we have 3M, which is down 2.75%, and then IIPR, which is down 14.49%. Now, as you guys, may recall from previous videos when I speak about our REITs, which Newt had been at the top of our list for quite a while. Realty Income has pretty much always been up here in the top kind of five as well. And then IIPR was the newest company we added to our portfolio. And again, REITs are very volatile. We know that the real estate industry can be, it can be kind of flaky. It's up and down, up and down. It's all over the place. So we're not really worried about this right now. We are going to really more so depend on these REITs, not for the crazy, us wanting to see crazy gains with the stock price from our REITs, but instead the dividend payouts that we will get from these REITs. And since we are taking a dollar cost averaging approach, we're not worried again about being down right now, similar to our growth portfolio, because we continue to buy at these low prices, at these discounted prices. So yes, technically we're down about $25 with IIPR. But like I said, in the long term, one, we're able to buy more shares at these lower rates, which is allowing us to build up our pool of total shares that we'll have, but we're also going to be continuing to get dividends from all of our companies in this portfolio, but especially the REITs. So I wanted to dive in. We're not going to, so we won't focus on IIPR today since they are at the bottom of our list. But 3M is a company that I do want to dive into and just share this article with you guys about it potentially being a good time to add 3M to your dividend growth portfolio if you haven't already. And of course, I believe anytime is going to be a good time with a company like this. 3M is trading for less than 18 times its earnings. This conglomerate has increased its dividend for 62 years. The current opportunities, fundamentals, and valuation imply that 3M is an attractive addition to your portfolio. So, the latest market, while not a bear market, has shaken some investors. Investors who were focused on small cap growth and enjoyed an amazing run found themselves in an awkward position. Their investments were down 20%, 50%, and even 70%. While I do hold some small cap growth companies in my Roth IRA, my main asset is my dividend growth portfolio. And I will note really quickly, if you guys are a regular on this channel, our growth portfolio is down quite a bit. We are getting hit hard. We are part of this flow of investors who are getting shaken, but we're not getting was going to say breaking, but that don't work. But we aren't broken. All right. Y'all know I was trying to make it rhyme. That would have worked if I said it correctly. We ain't shaking and we aren't breaking. Yeah. So some blue chips are also suddenly much more attractive. After getting used to buying shares for PE ratios above 20, we see some more attractive valuations across the board. As interest rates are on the rise, we may return to a world where great companies are trading for a PE of 15 to 18. And one great company that I intend to cover is 3M. According to Seeking Alpha's company overview, 3M Company develops, manufactures, and markets various products worldwide. It operates through 4 business segments: safety and industrial, transportation and electronics, healthcare, and consumer. The company was founded in 1902 and is headquartered in St. Paul, Minnesota. Its fundamentals: revenues have been growing slowly over the last 5 years with an annual growth rate of 3%. 3M is a steady, slow mover. Most of its growth is organic, as the company is acquiring business from time to time to supplement its current offerings. According to the consensus of analysts on Seeking Alpha's company overview, investors should expect a low single digits annual revenue growth in the medium term. The EPS has been growing faster than the revenues. The EPS growth is fueled by revenue growth, share buybacks, and margins expanding over the last 5 years. The company expects to keep improving its margins by cutting costs and buying back more shares. According to the consensus of analysts on Seeking Alpha's company overview, investors should expect a mid-single digits annual EPS growth in the medium term. The dividend is one of the brightest spots in 3M's history. The company has been paying a growing dividend for 62 years, and investors should expect another dividend increase in February. However, investors shouldn't expect a large hike, as the company is already paying close to 60% of its EPS. The dividend is safe, and the current yield is attractive at 3.25%. In addition to the growing dividend, the company is also utilizing some of its FCF for share buybacks. Investors shouldn't expect aggressive buybacks, but the company is making sure that investors are not diluted. In addition, as the graph below shows, the company does manage to lower the number of shares outstanding modestly. A combination of safe dividends with optimistic buybacks will benefit shareholders in the future. Valuation. The PE valuation of 3M has dropped significantly since its highs in the spring. The company is now trading for less than 18 times its forecasted earnings for the year. In a world where the indices are still close to an all-time high, finding companies that trade for a decent and fair valuation is good enough. 3M is a good company at a fair valuation. And the graph below from Fast Graphs emphasizes that 3M is not trading for an attractive valuation. The average PE for 3M is 20, and the average growth rate is 7%. Right now, the forecasted average growth rate is still around 7%, and 3M enjoys a valuation more attractive than its averaging valuation over the last 20 years. To conclude, 3M is offering investors an investment with great solid fundamentals, growing revenues fueling growing EPS, which turns into growing dividends. This package is packed at a fair valuation that should suit dividend growth investors. Opportunities. Digitalization is an important growth factor. 3M is an old company. It will celebrate its 120th birthday this year. The company has some product lines that are brand new, while others are 70 years old. Old lines mean less efficient work, and the company is investing heavily in renewing its lines, adding lot platforms to command and control them easily, and hiring companies such as Palantir and C3.ai to utilize AI to extract more insights and value from the data it has collected. And I want to note really quickly, my friends, notice who they are hiring to help them with becoming a more efficient and, kind of updated company. We have Palantir inside of our portfolio. Not in this portfolio, in our growth portfolio, which I made a video talking about Palantir and why I'm not worried about Palantir also being down right now and them being a great opportunity to get them at such a discounted rate. You are seeing powerhouse companies like 3M, who have been around for years, over 100+ years, and they are relying on these new companies to help them with transforming their businesses for the better. This is why we are doing our research, but also to find these gems in a company like C3.ai, who I'm not even familiar with them, but knowing that 3M is again working with them, I can imagine other companies are also relying on them to help them with improving their businesses as well, which means this could also be a good potential opportunity as well. So we're going to save them and remember to look this up after the fact, because this could be another good growth opportunity. No, it might not even be a growth company. We got to look into it. But continuing with 3M. Rotation from growth to value is also a positive prospect for 3M. Growth stocks are being abandoned as investors are looking for safer investments. In a business environment with higher risks and less monetary stimulus, investors seek once again the safe havens that grow slowly but steadily. 3M will enjoy this rotation as it is one of the most suitable industrial companies on Wall Street. The company's track record is another opportunity in the medium term. The company has a proven track record of growth and a 62-year streak of dividend growth. If we indeed go to a more inflationary environment, investors may choose the companies that have been there in the 1970s and know how to handle the challenge. Risks. Lack of business focus. The company is an industrial conglomerate with very little business focus. It produces thousands of different products for dozens of industries. Usually, diversification is a positive trait for a company, yet sometimes you can get over-diversified. Diversification is great, especially when your products are revolving around a sector and you can cater to the entire value chain. But it's more challenging in the case of 3M, and the management will have to delicately manage it. Supply chain struggle is another risk. The company is already affected by supply chain bottlenecks. This may escalate even more in the current environment as the Omicron is making it harder and harder for plants to stay open. This is probably the largest single challenge for 3M in the short term due to its vast diversification and huge catalog. Inflation is the third risk. 2021 ended with a 7% inflation rate. Inflation has made the basic materials used by 3M more expensive, and in turn, it will have to deal with increased prices or suffer from shrinking margins. It's either shrinking sales or shrinking EPS, and most likely a combination of the two. The company will have to become leaner and more efficient to compete in this environment. So in conclusion, 3M is nothing but a great company. Yes, it is a slow mover, but more importantly, it's a steady mover. The company grows its revenues, earnings, and dividends steadily for decades. It has several growth opportunities that will make it more efficient. And there are several risks that 3M will have to deal with, but these are mostly macro risks, and the company has proven its abilities in dealing with them in the past. As more investors shift towards safer investment, dividend growth investors who sometimes lag the market should keep buying these quality blue chips and ride the wave. So that, my friends, is why we have 3M as part of our dividend portfolio and why we will continue to invest in them, especially at these low rates, these low prices. I mean, these are sales. IIPR, 3M, when they're down, we don't panic. When you see our growth portfolio, yes, it's more risky, and you certainly got to be more cautious, but it's a similar approach, similar mindset. You're looking at a stock that is on sale. It's cheap for where you believe it will be and where it has been. So on that note, what do you guys think about 3M? What do you guys think about our portfolio in general? Any thoughts, any suggestions, any comments? Feel free to leave them down below. And while you're down there, don't forget to smash that like button. And of course, subscribe to our channel and hit the notification bell so you can stay up to date on all of our latest and upcoming video content. But all right, my friends, enough from me. You already know I got to keep it moving. But much appreciation for watching, and I'll see you in the next video. Peace.